So hello guys, magandang araw sa inyong lahat. Ako nga pala si Jayson P, Cainglet. So now, ang pag-uusapan natin for today's vlog ay about the Board of Directors Rating Loan Policy. Pero bago tayo magsimula, atin munang alamin ang ating objectives para sa topic na ito. So una, know the importance of banking and financial institution. Second is, know the function of the Board of Directors in relation to loan policy in banking industry. So ano nga ba ang meron sa Board of Directors in Loan Policy? So sabi dito, the Board of Directors has the ultimate responsibility for all the loans made by their banks because the board delegates the task of making loans to others. It must have written loans policies that establish the guidelines and principles for all the bank's lending activities. So, ibig sabihin, ang board directors ay may responsibilidad sa lahat ng loans transaction ng bank dahil ang boards of directors ang representative for the task of making loans to others. When it comes in making loans to others, the board of director must have written loans policy na nakasaad sa mga guidelines and principle for the bank's lending activity. And also, ang loan policy is vary widely from bank to bank. Magkaiba ang loan policies ng small bank that primarily to local customer kumpara sa loan policies ng large bank that specialize in lending to business concerns. The loans policy is based on the amount of the benefits that they get from the loan.
It's my turn to discuss about the Boards of Directors written loan policy. In either case, the policy would state that the bank is in the business of making sound and profitable loans. Therefore, the loan policy must make it clear that an important part of lending process is that all loans should have a repayment plan at the time loan is made. Sinabing bangko, ang agad naman sumasagi sa isip natin ay pera. Sa bangko, pwede kang mag-deposit, pwede ka rin mag-loan. If you are a membership of a bank, pwede kang mag-loan. So the bank has many rules before making a loan. So the bank is stricter when it comes to lending. Marami silang patakaran para ma-aproba yung pag-loan mo. And they make sure that their approval of someone lend does not violate their policy. The other parts of the loan policy deal is number 1, loan authority. So what is loan authority? It has who has the authority to make loans. Ito ang authority sa pagsasagawa ng isang loan. Because the lending limits relative to capital deposit or asset. So, it is a loan approval process. So, the second one is the loan portfolio. It is the type of loans that banks want to make such as consumer loan, loan to start up business. Third, loans to large business. Fourth, farm loans or international loans. The policy should also put limits on the concentration of particular types of loans. So, loan portfolio is one of the reporting indicators that are part of the asset of credit organizations. Ito ay dapat balansin ng lahat ng mga pautang na ibibigay ng bangko sa bawat isa na gustong mag-loan. Ito yung balance of all loans the bank has issued for individuals and entities, such as consumer loans, loans sa pag-start mo ng business, loans sa mga malalaking business, mga farm loans, and international loans. So, let's proceed to the next presenter.
The Board of Directors written loan policy. Number 3. Geographic limits of the bank's trade area where it may grant loans. Banks should establish overall credit limits at the level of individual borrowers and counterparties and groups of connected counterparties that aggregate in a comparable and meaningful manner different types of exposure, both in the banking and trading book and on and off of the balance sheet. Number 4. Policies for determining interest rate, fees, and contractual terms of the loans. Loan agreements are binding contracts between two or more parties to formalize a loan process. There are many types of loan agreements. ranging from simple promissory notes between friends and family members to more detailed contracts like mortgages, auto loans, credit cards, and short or long-term payday advance loans. The main purpose of a loan contract is to define what the parties involved are agreeing to, what responsibilities each party has to, for how long the agreement will last. A loan agreement should be in compliance with state and federal regulation which will protect both lender and borrower should either side fail to honor the agreement. Terms of the loan contract and which state of federal laws govern the performance obligation required by the both parties will differ depending upon loan of type. Number 5. Limit and guidelines for off-balance sheet and exposures for loans commitments, letters of credit, securitized loans, and derivative products, swaps, option, futures, and so on. Off-balance sheets financing is accounting practice that allows company to keep certain assets and liabilities off their balance sheets, although they may not be present on the sheets that they still belong to the business. Off-balance sheets is commonly used by businesses that are highly leveraged, especially when taking on more debts means a higher debt-equity ratio. The more debt a company has, the higher the risk of the default for the lender. This means charging a company a higher interest rate. A balance sheet exposure is a monetary account balance denominated in a currency other than the entity's functional currency. Typical accounts, among others, that create balance that exposure include foreign cash account, receivable, payable, tax paying, and internal company accounts. Number 6. A loan review process to evaluate lending procedures and the quality of a loan portfolio. A loan review provides an assessment of the overall quality of a loan portfolio. Specifically, a loan review assesses individual loans, including repayment risk, determine compliance with lending procedures and policies, identifies lapses in documentation, provide credit risk management priority findings, recommends practice and procedures to address findings. Loan review identifies risk issue and evaluates what modification can be made to lending procedures, policy, and practices to reduce risk. Organizations that fail to address problems early are vulnerable to systematic weaknesses that can lead to deterioration in portfolio quality and ultimately to declining profitability and sustainability. A loan review is usually not an assessment of a loan loss reserve, even though the risk rating for each individual loan review may be evaluated. A loan review typically does not provide an overall opinion of adequacy of a loan loss reserve. However, it is significant percentage says around 10% or more portfolio review results in risk rating downgraded than result and may indicate an accurate loan risk reserve.
So, thank you so much, Miss Coloma. So, ngayon guys, durugtungan ko ang topic ni Miss Coloma, which is nasa 6th na statement, ang loan review process to lending procedures and the quality of that loan portfolio. So, siguro na-explain na ni Miss Coloma ang part niya. So, durugtungan ko na lang yung kanyang explanation para mas maintindihan din po ninyo. So, kahit hindi kumpleto ang pagbigay ng listahan, it is still sufficient to give you an overview of some of the key topics na covered ng isang loan company or ng isang loan policy. Kailangan rin maging specific ng isang company sa iba't ibang klase ng loans para mas maintindihan at para mas malaman ng isang client kung ano yung pinapasok niya at para mas malaman niya kung ano ba yung ibang klase or may iba pang mga klase ng loans. So, for example of this is, the bank should not make loans to the person na questionable ang kanilang honesty at ang kanilang integrity. Next is, hindi pwedeng mag-offer ng loan for capital business kung hindi kayang bayaran ng isang business company ang kanyang loan. Unless may liquidation ang isang business company, exemption yun siya. And lastly guys, it shouldn't make loans secured by stock where there is no market for that stock. Market stock, it is a market where public firms' share are traded. The primary market is where corporations raise cash by selling shares to the general public in an initial public offering or IPO. So, ibig sabihin, shares of common or preferred stock that are used as collateral to secure a loan from another party are referred to as loan stock. The loan has a fixed interest rate and can be secured or unsecured, much like a traditional loan. If like an irredeemable, convertible, unsecured loan stock, a secured loan stock can be directly converted to common shares under defined conditions at a predetermined conversion rate. It is referred to as convertible loan stock. So, thank you guys for watching. Sana marami kayong nakuhang lesson dito sa ating loan policy. Pwede nyo balikan ang aming video para mas maintindihan at may marami pa kayong makuhang knowledge about loan policy. So, thank you guys for watching. Bye!